Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. We've had a huge number of developments occur over the past few weeks. We've been hard at work making these videos, posting the research on our website, and trying to keep up with everything that's going on. So it's been a very tough market environment to navigate, a huge number of whipsaws. And so the subject of this video is actually going to be on the 2-year yield. It spiked over the last few days right here. And we know the 2-year yield has a huge influence on the stock market. It's been a huge fuel to this correction that we're seeing. And in fact, the rally that we've seen here has been in part driven by this 2-year yield stabilizing. So what does this mean here? What does this rise in the 2-year yield mean for the stock market, for the rally? Is it going to put a big dent in the bullish case? Should we expect this 2-year yield to continue spiking in a similar way to what we saw back here in February and March, and what really essentially caused the second half of this correction? So that's exactly what we're going to talk about in this video. If you enjoy this episode, don't forget to smash that like button and subscribe to the channel if you haven't already. It really does help our videos get pushed out to a wider audience and makes the effort that we put into these videos worthwhile. So it is really appreciated. And now without further ado, let's get right into it. So we know how the 2-year yield impacts the market, right? This is a 30-year chart of the 2-year yield. Let me put the SP 500 on top and you'll quickly see what I'm talking about here. I'm going to highlight these zones right here. These are periods where the 2-year yield is rising, and it very often corresponds to periods where PE ratios are coming down. This period right here, believe it or not, PE ratios were going down throughout that period. The same thing applies to this entire period right here between 2004 and 2006. The 2-year yield was rising, PE ratios were coming down. So this has really driven a large part of this correction that we've seen. It's been the rise of the 2-year yield that's really been putting a lot of pressure on PE ratios. And you can see PE ratios dropped from around 23 here to 16 very, very rapidly just over the course of 2021 and the beginning of 2022 as we've seen this 2-year yield rise. Now, a large part of what makes up the 2-year yield is the market's anticipation of monetary policy, what the Federal Reserve is going to do. That's very, very important. And so we can look at that through the euro-dollar future. This pretty much tells you what the market is anticipating in terms of monetary policy. Now I'm going to invert this chart so that it makes more sense here, and you can actually see what this looks like. It looks exactly like the federal fund rate. Let's add the Fed funds rate on top of this chart. And so you can see typically they move together at the very same time. The market's anticipation of monetary policy is in line with monetary policy itself. And what's happened here, we've had the Fed be very, very behind the curve, right? And we know that they've been behind the curve. This is just a chart highlighting to what extent that is. But so this gives you a counter argument to the people saying that the hiking cycle is still happening. It is still happening, but a lot of it has already been accounted for by the market. And in fact, over the past few weeks here, we've actually seen the market expect easier monetary policy. And if we superimpose the stock market with this chart here, you'll quickly notice what I mean, that this is pretty much what drove the bottom, right? As soon as the market started to anticipate future easing of monetary policy, that's when the market put in that bottom and started rallying, right? And so this is why it's so important. This is why we look at the 2-year yield and the euro-dollar futures. And in fact, the same thing happened right here, right? In 2018 here, the euro-dollar futures started to come down and the market put in a bottom just a few weeks later. And an easy way of looking at this chart is just by looking at the 2-year yield. It's pretty much the same thing. And you can see it's been retracing part of that move down recently. So this is something to watch out for, because a lot of the bullish case for stocks right now, especially if we're looking for stocks to rally much higher, we want to see the 2-year yield really cool down, right? In a similar fashion to what happened during 2019, you had the 2-year yield really cool down here, and that managed to bring the market back up to its highs because you had the 2-year significantly lower, and so valuations could expand. And I can show you valuations throughout that period. They were expanding here, right? PE ratios were going up. If we start to see the S&P rally significantly here, but we also see the 2-year rise, that's going to be a big warning signal. And so that's one of the things that we're going to be making updates on the website, evaluating the health of the environment, right? Because in a very similar fashion to the March rally here, the 2-year yield was rising, telling you that valuations should be coming down and that you really shouldn't be seeing valuations expand here. So we're going to be making real-time updates on that if we see significant upside in the stock market, and whether or not the macro environment is confirming that move, or if it's telling us we should still be looking for valuations to come down, and whether that's going to be an opportunity to actually book profits on the way up. If you're interested in getting live updates and notifications on those kind of developments, that I believe is really one of the most important aspects of the market today, and whether the pressure that we've seen throughout this correction of contracting valuations as the 2-year is rising, whether that pressure is going to be relieved, or if we're actually continuing to see this pressure and we're actually going to be able to buy stocks at much lower PE ratios. And when you start to get into those much lower PE ratios, that's when you start to get into long-term buying opportunities as the market starts to look very cheap. Now, of course, the second part of that equation is the earnings side, because in PE ratios, right, PE ratios are valuations, and so you can have the 2-year yield coming down as much as you want, but if that earnings part of the equation, if the earnings are coming down because the economy is collapsing and we're heading into a recession, if that ends up being true, well, you can have all the valuation expansion you want, but you're still going to have a falling stock market. And that's why we posted this work on earnings this week, where we actually took a look at historical examples of earnings. Now, one more way I can illustrate the point I want to make in this video is basically that the Federal Reserve is very behind the curve. The market seems, at least for now, it seems to have priced in the entire tightening cycle. All of it has been discounted. Now, of course, this is going to have massive repercussions a year from now, right? Let's not even get into that. And the fact when you have these types of large moves up in rates, it has an impact on economic activity around a year later. But we're not talking about that right now. What I'm talking about is the fact that the market has discounted the tightening cycle, meaning the restriction of capital in the short term. And it's done that very rapidly without the federal fund rate having had time to catch up to it. And I wanted to actually take a look at the last time we had that. So I looked at the 2-year minus the federal funds rate that essentially gives you that spread between the 2-year and the federal fund rate. So it tells you basically how far ahead or behind the Federal Reserve is relative to the 2-year yield. And you can see very clearly that we haven't had this type of reading since 1994, right? So the Federal Reserve has been very behind the curve here. So that begs to ask the question, should we wait for the 2-year yield to roll over, or should we just wait for the Fed to pivot and finish their tightening cycle? Because we know they still have at least 2 rate hikes ahead. That's very likely what's still ahead of us. So does that mean that the rally cannot rally ahead of that? And so we can actually go back and take a look at what happened here the last time we had the Federal Reserve so much behind the curve. So let's take a look at the S&P 500 in 1994. Let's add the Fed funds rate and let's add the 2-year yield. And hopefully you'll understand where I'm coming at here. And you can see the market pretty much bottomed right here. And this coincided perfectly with the top in the 2-year yield. And that was in December 1994. Now the Federal Reserve, only stopped hiking rates in March 1995, so a few months later. By the time that was the case, by the time the Fed actually pivoted on their monetary policy and started to ease again, the market had rallied a total of 15% off its low and was trading at all-time highs. Now, that doesn't mean that the same thing is going to happen again, but hopefully it opens up your mind to seeing that type of outcome. Perhaps this is a cycle here because of how far behind the Fed is. This is a cycle where we need to be watching the 2-year and not necessarily the Federal Reserve. We need to be watching what the market is anticipating and not what the Federal Reserve is doing, because we know what they're going to do here in the next few meetings. They're going to be hiking. But what is the market anticipating is going to happen after those hikes is perhaps more relevant today than in these 3 previous cycles, where investors have gotten used to the Fed being in line with what's happening in the bond market. That is our approach right now. It's why we're looking at the 2-year very carefully, and we're actively updating you guys on the website on this and seeing if we can see this rally get confirmed by this move in the 2-year, or whether on the way up we should be looking to book profits, because the 2-year yield is telling us there's still a lot of room for that hiking cycle to extend much higher than 2.6 or 2.8%. And we could potentially see the hiking cycle go a lot further and a lot longer than what's currently being priced in. We're going to be watching that very carefully. If you enjoyed this episode, don't forget to smash that like button. Also, if you want to have access to those updates, don't forget to click on the link down below and access gameoftrades.net. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. Now, in the meantime, I wish you good luck on your trading and see you next time.